Great pleasure to welcome you here to CSIS on a Friday evening, a beautiful Friday evening, spring in Washington, for a very special occasion, what I would describe as probably the preeminent event of the weekend, given the lineup we have this evening. First, we'll hear from Mr. Jörg Asmussen, who has had a distinguished career at the finance ministry. Obviously, he's now with the European Central Bank, where he joined in January, but prior to that, he was State Secretary of the Finance Ministry and then the Director General within the Finance Ministry, and had started in the Finance Ministry back in the mid-90s. I first got to know Jörg about 7 or 8 years ago, and you couldn't help but enjoy being with him because he has this wonderful combination of this kind of affable mannerism, a very keen intellect, and the capacity to solve problems. And when you're working in government and you've got 7 or 20 individuals around the table and countries represented, you want people who help solve problems rather than create problems. And it's a great skill of Jörg's, and it was no real surprise when we've seen throughout the crisis of the last 3 years his rather rapid rise to the ranks. It was thrilling to watch, but again, no surprise. And I tell you, I sleep much better at night knowing he is at the European Central Bank and making decisions there. After his commentary, we'll get a brief response from one of Germany's noted politicians, someone who spent a decade in the Bundestag, whose background during that time was mostly on foreign affairs, but has a wide range of knowledge and experience, serving as the Minister for Defense, the Minister for Economy and Technology. We were just talking about some of the issues he's been working on with respect to technology and the internet. But a dashing German politician who I would put money on it might be in the Chancellor's chair someday, and I hope when you are, you'll remember me. And lastly, but certainly not least, monitoring the question and answer period is our own Heather Connolly, who's in charge of the European Studies program here. I'm sure all of you know her well, and the work she's done. She had a distinguished career in government herself, serving as the Deputy Assistant Secretary of State for European Affairs. So, Jörg, welcome, and I look forward to your comments. Thank you.
Now? Okay. So Tim and Mr. zu Gutenberg, it's a real pleasure to be here today at the Center for Strategic and International Studies, and I would like to thank you, Mr. zu Gutenberg, that you take the initiative. And Tim, I'd like to thank you that you managed to be here. Thanks for the very kind words, and thanks for being such a reliable partner on this side of the Atlantic for many, many years, even in difficult German-US relationships sometimes. In recent US foreign policy discussions is whether more to disengage from Europe and to focus more on the Pacific. When one comes in these days around the spring meetings to Washington, it seems very different. People in Washington seem to be more interested than ever in European affairs. And unfortunately, this is for the entirely wrong reasons. So I think sometimes it's really nice if one could go back to these days of being irrelevant. I would set the stage for our discussion today, addressing some of the key issues of the crisis in Europe and our response to this. The issues, I think, go to the heart of the major debates in the US and in Europe. And they are complex. They require long-term thinking. We need to avoid simplifications, but they are at the very end about what kind of Europe we want for the future. And I would focus my intervention on 3 questions. The first one, is the worst of the crisis over? Second, is the European response to the crisis killing growth? And third, is the ECB response to the crisis swamping the world with liquidity? Policymakers are often asked if the worst of the crisis is over. And this is a difficult question to answer. If we are optimistic, we are accused of cheerleading. If we are pessimistic, we risk panicking the markets and settling off self-fulfilling cycles. So we have to go what the data tell us. And the data show us a clear stabilization in the global economy since last year. The US is showing signs of a sustained recovery. The data releases have consistently surprised on the upside throughout the first quarter of this year, even if April was a little bit mixed. But survey data really point to a moderate expansion of economic activity in early 2012. And unemployment in the US is now at the lowest level since January 2009. In the euro area, data confirm a stabilization in economic activity at low level in early 2012. So we continue to expect to have a very mild recession in the euro area and that our economy will recover gradually in the course of the year. Our outlook is supported by strong export growth to the US and to emerging markets. But downside risks remain related to a possible worsening of the sovereign debt crisis. Financial markets are now generally less volatile. Also, we must very closely monitor the situation in the Spanish government bond market. But certainly the doomsday scenarios from the fourth quarter of last year seem to have be avoided. And we should not forget that only 5 months ago, Der Spiegel, that's the leading German weekly magazine, ran an article entitled "A Continent Stares into the Abyss," which declared that the end game for the euro had begun. The front cover of The Economist in the same week asked, "Is this really the end?" set against an image of a burning €1 coin hurtling towards oblivion. What changed in this time? And in my view, the explanation is action taken at 3 levels. First, member states recognized the seriousness of the situation and have implemented major reforms. For example, Spain has begun addressing its competitiveness problem with the most significant labor market reform in a generation. It has also improved central control over regional spending. Italy has increased competition and is modernizing its public administration to increase potential growth. The debt exchange in Greece was successful, which gives the country a fresh start to address its fiscal and competitiveness issues. And Ireland and Portugal have continued to implement their EU IMF programs, which are both on track. Second layer of action, Europe has strengthened its economic governance. The fiscal rules have been reinforced through the agreement called the Fiscal Compact. This is an agreement that obliges all euro area countries to run a structural balanced budget. And it also shifts the onus for enforcement away from Brussels and onto national institutions, encouraging greater ownership. The monitoring of economic policies will go deeper through what we call the new enhanced surveillance legislation. It allows the EU Commission to send missions to countries experiencing or threatened with financial difficulties and recommend policy changes. This gives the Commission a power to demand the reforms that the US federal government could not demand of a US state. Euro area firewalls have been strengthened by the decision to increase the total resources to around $1 trillion. This will be complemented by the decision today to increase the IMF resources. And altogether, this presents, in my view, a convincing package to markets. It's a tough set of rules, strong regime for monitoring those rules, and a credible safety net to back it up. Third layer of action, the ECB has played its part by preventing a funding crisis in the banking sector. The 2-3-year LTROs launched in December and February have eased bank funding pressures and stopped further deleveraging. This, over time, should support lending to firms and households across the euro area. These actions have pulled the euro area back from the very dangerous situation we faced last year. But the crisis of public and private debt in some countries is clearly not over. The recent rise in Spanish yields is evidence of this. This is no longer a problem that can be addressed through bigger firewalls or a more active ECB. It can only be addressed through consistent and determined reform, even if it's painful in the short term. In the Spanish case, the shift of market sentiment is a result of poor communication on deficit targets and delays in announcing the budget. In other words, Spain obviously has currently a credibility problem with the markets. But I think this can be fixed by taking measures to regain credibility. Overall, we should not wait for a silver bullet to end the crisis. It does not exist. The end of the crisis will come only after a series of comprehensive steps from taking over a number of years. This means all member states and EU institutions playing their part. I want to stress here that we are greatly helped in this task by the excellent transatlantic cooperation, not least between the ECB and the Federal Reserve. That means, among other things, the provision of dollar swap lines was a key weapon in fighting the crisis in 2009 and last year. So the US is really playing an important role in supporting the European recovery. This leads me to my second question. Is the response I just described, fiscal consolidation and structural reforms, is this killing growth in Europe? And I think it's important to understand that we see here things differently in Europe and in the US. In our view, strong public finances are a precondition for sustainable growth. We see fiscal consolidation as supporting growth because it creates confidence effects that will support consumption and investment in the future. It's certain that short-term effects of consolidation can be negative. We recognize this, we know this. And this is why we always recommend that consolidation is accompanied by productivity-enhancing structural reforms. This means inter alia, because this has to depend on the various situation on the ground in the different member states. Opening up closed professions, key one always is taxi drivers. It means increasing the efficiency of public administrations and improving and completing the common market. These are reforms that will at the end benefit the majority of people by increasing the growth potential of these economies. Take the example again of Spain. The labor market reforms that I mentioned are essential to increase employment. The Spanish labor market has for too long been organized in a way that protects insiders. This is what lies behind the very high rate of youth unemployment. It may be the case that these reforms will not return some of the current problem countries to pre-crisis growth rates. So there will be for sure calls for more stimulus, but we should keep in mind that the last 10 years were not representative. It was a boom period on credit, creating ever larger imbalances. This party is over now, and we need to learn the lessons from it. And the lessons from the bursting of a debt bubble cannot be to load up on more debt. These countries need reforms that undo previous excesses, consolidate and rebuild their economies on a more sustainable basis. This is the direction in which Europe is currently heading, and there is really no alternative. There's one area, however, where I fear we are not learning the right lessons in Europe. Several European countries face a vicious circle where weak domestic banks cause fiscal difficulties for the government, which in turn undermines public debt sustainability and further damages bank balance sheets. In the US, such a feedback loop does not exist because federal institutions act as a shock absorber. They prevent local crises from becoming systemic. For example, banks can be recapitalized through the US Treasury and resolved through the FDIC. And in Europe, we need, in my view, to look to the US for inspiration in this area. And this is why I have called for a European Bank Resolution Authority. And if we cannot do this at 27, then let's do this for the Eurozone. And this is what my colleague Benoit Cœuré also had today argued in Princeton. Third point, I would now turn in more detail to the recent actions by the ECB. In particular, the questions if the 3-year long-term refinancing operations, the LTROs, have swamped the world with liquidity. And behind this question is the implication that increasing central bank liquidity always leads to distortions, be it inflation or currency volatility. But this misunderstands what central bank liquidity is. ECB liquidity is a very specific form of money. It can be used only to make payments between banks with accounts at the ECB or to meet reserve requirements. There is no automatic mechanism which converts this liquidity into loans or asset purchases. Banks take such decisions based on factors like their financial strength, their risk aversion, but also on what is the demand for credit by non-financial corporations and private households. So we should not make simplistic assertions about one factor leading to another. We should again ask, what do we see in the data? And looking at credit growth in the euro area, we see few signs of distortions. The LTROs have certainly prevented an abrupt deleveraging, but loans to the euro area private sector increased by only 1.1% in February, compared with an average of around 7% since the start of the euro. Looking at capital flows to other parts of the world, we see a broadly balanced picture. The euro has in fact appreciated in effective terms since we conducted the first LTRO in December. But there have been significant capital inflows to the euro area due to renewed interest and renewed confidence by foreign investors. On the bank funding side, we see a real difference. Euro area banks have issued $55 billion in senior unsecured bank debt in the first 2 months of this year. And this is more than the whole amount they have issued in the second half of last year. And preventing a bank funding crisis is exactly what the LTRO was intended to achieve. And over time, we would expect this to feed into higher credits to firms and households. When this happens, we will be constantly alert to any threat of inflation. Our commitment to price stability in the euro area is firm and credible. And I think that observers recognize this. And following the 2-3 year LTOs, market indicators of inflation expectations show no signs of inflation above our medium-term objective. So to conclude, the euro area certainly has still a lot of work to do to put itself back onto a sustainable footing. The work is difficult because it goes to the root of our economic problems, but it's also essential. Solutions that only paper over these problems by creating more debt are not in Europe's long-term interest. They would solve the crisis by creating the conditions for the next one. But we also need to be patient. The euro area is made up of 17 different democracies, and you here in Washington know pretty well that democracy sometimes can be messy. Events may not play out as an economist would determine in his or her model as a kind of first best solution. But important is that in the end we get there. And I'm confident that in Europe we are heading slowly but surely down the right track. Thank you very much again for the invitation and for your attention.
Work?
You're gone.
Yeah, it does. Okay. Thank you very much for possibility to be here tonight. Heather, for your leadership. Tim, for introducing us. And thank you very much, Jörg Asmussen, for coming tonight. I'm delighted to see you again. We have had many, many experiences together during the last couple of years. We worked together very well, I have to say, and I had the impression that sometimes we shared even more convictions than we actually could admit. And it's a pleasure to see you again. Thank you for your most thoughtful remarks, for quite clear messages that I think will be understood over here. Maybe not all of them embraced, but certainly understood, and it was a clear language, and I think that's absolutely of utmost importance if we address those issues you have just talked about. I would just give a couple of quick remarks, assessments of an observer who is now on the other side of the Atlantic, and although the Atlantic is quite stormy from time to time, it's pretty useful to see Europe from this side of the Atlantic and to have some distance to gain a couple of impressions. And first of all, I'd like to start with some impressions regarding the current state of play, how I see the crisis also from a political standpoint and from some experiences I've had during the last couple of years. And I entirely underline some of your last sentence. You've said we need patience, and I think I can only say I think we need quite some patience for the next time to go, and some patience regarding also or in respect of the impression I still gain that some of the significant players, not all of them, and certainly not you, but some of the significant players still give us let's say also an impression of kicking the can down the road. And if I say that, I mean a road which is clearly aiming towards national elections. And in this context we have to see how do we somehow combine the interests you've just been talking about with national interests that are always linked to electoral thinking, and to somehow being driven by certain elections. And there are important elections just ahead of us, and one will be just in a couple of days, and we'll see what the outcome will be. And then we have specifically in Germany, and I would say a couple of things about Germany also in the next 2 to 3 minutes to come. We have quite a remarkable number of state elections coming up in Germany, and the federal election next year. And you need to be quite brave as a German politician to de-link your thinking from these elections. And I'm not too optimistic when it comes to the point that everybody will de-link his thoughts from these elections. And I will the mildest price I can find for that. So one the question, or maybe the one point that comes up very easily when we're talking at the moment about the ECB and the measures you have just put on the table, is the question whether there is a long-term connection between ECB and also maybe even IMF money, and I think we've had some good news today regarding the IMF, and reform laziness in certain European countries, not only looking at the south of Europe, but I think that's one of the questions that still have to be resolved. I'm very happy about the message you have just given, that you've said there has to be I put in my own words now, but there has to be also a reformist approach, and it cannot be only receiving money. And that's one of the debates that I still imagine as being one of the toughest, also specifically in Germany, how to bring that in a balance and how to find a solution here. Secondly, and I think the same is true also for the interrelation of a potential fiscal union and the necessity to give up further national sovereignty. And that's a question we have been discussing now for many, many years. But this is also one of the points which we need to interrelate to patience. And if we are talking about a fiscal union, we have to see now a first step we have made in Europe, and this is this fiscal compact. And I see it as a significant and a very useful step. But if we want to go further ahead, then we have to see the necessity of probably going into a tax harmonization and other things. And taking this into account, I think we will face huge obstacles in certain national states to come to such a solution and to come closer to any of those things. The third point I'd like to make, it's a banality, but it's just an impression from over here, and you can certainly correct me. But, and again, you are more than an exception, but I sense some, let's say, exhaustion amongst certain key players in Europe when it comes to the question, do we have to make the next round now of how to resolve the crisis, or the crises actually we're in right now. And this is somehow linked to a follow-up question, which what happens if a reform fatigue kicks in? And what if suddenly populists gain power in certain governments? Just an example, maybe this gentleman from the Netherlands, Geert Wilders. Or what happens? Just another example, if a unreformed Samoras in Greece just. And I call him an unreformed Samoras, comes into power. What does it mean for all the steps we have been made so far? A major concern I have from a political standpoint, looking at Europe right now, is a possibility that the heterogeneity of the Eurozone and of the European Union even widens at the very moment. And this is also again connected to the question, how can a monetary union function if the economies move apart? So we see, and that's a truism, but we see economies of rather significant, different or distinct power, and it's not that I don't see them moving together right now. Some of them they are moving apart. So, what is the logic outcome of this, and how do we really tackle this very question? I'm more than happy to see you at the ECB dealing with these questions. To be honest, ladies and gentlemen, it's his move to the ECB is a gain for Europe and quite a remarkable loss for the German government. But as he always pointed out, he is a German European or European German, and he's certainly capable to address all the things he needs to address, and he showed us tonight. Just two more remarks regarding also specifically Germany. One is on the question, how do international dreams relate to German reality? And if I talk about German reality, I try to talk about the political reality in Germany. And in this respect, I think that some of the proposals and ideas, specifically which we've heard from the IMF during the last couple of days, are almost illusory to debate or to decide in an election year, and brings me back to the point of the election year. Just to give you some bullet points, again and again, the example of Eurobonds. I think we are far away from being close to a decision here when it comes to Eurobonds. The second is softening budget restraints, and you have already pointed at that. I think it will be incredibly hard to convince the German public on that very point, and to win elections over such a point. The third thing I'd like to also to see in this regard is if European money, specifically from the ECB, is directly being pumped, in quotation marks, into the banking system. And this is still highly difficult to transport as a message to the German public, and I fear that main political player will just shy away from delivering these messages within the next year to come as core messages for getting into further steps after the fiscal compact. So that's, and that brings me to a concluding point for this very issue. We are still lacking, not only in Germany but all over Europe, a comprehensible narrative of what's happening right now. And the complexity of the matter, of the whole matter we are discussing right now, is taken from many as a, let's say, as a bridging element to their policy measures. They use the complexity to somehow make decisions. That's not true for everybody, but it is. I don't see much light at the end of the tunnel right now when it comes to the question: are we already capable to deliver the key messages to the people in Europe? And the old narrative, let's say that the traditional narrative of what Europe is all about and what the European Union has achieved so far, this is a very true and a remarkable and necessary narrative. But many of the people, specifically in Germany, grew tired of it in the meanwhile. And I think we need a new narrative to explain the necessities you have just pointed at, and we need a new wording, a new language regarding this, because we don't reach the people any longer. I'd like to stop here, and just as a quick follow-up to what you have said, thank you very much again. I think it's most important and definitely a message you have brought over here, which helps those of us who try to explain Europe again and again. Thank you.
Carl Taylor, thank you so much for your response to Mr. Asmussen's remarks. And let me again welcome you all. I'm sure you could spend your Friday nights in other places, but we're absolutely delighted that you could spend your time here with us at CSIS. I'd like to thank Tim Adams, who is a CSIS Senior Advisor, in addition to his work as Managing Director of the Lindsay Group, who was so kind in his introduction. I borrow Tim as a former Undersecretary of the Treasury for International Affairs. He's been instrumental in helping CSIS figure out and understand the complexities of the debt crisis. And again, we're delighted that Carl Theodor zu Guttenberg is here as a CSIS Distinguished Statesman and helping us bring some context to this crisis. I'd like to remind everyone that this is an on-the-record discussion, and now is the fun part, which is the question and answer time. And we welcome your questions. I'm going to take the prerogative and ask one or two up here before I unleash you on our guests. But we just want to remind you, if you give us your name and your affiliation when you ask the question, that would be most appreciative. I have two questions, and they're sort of to both of you, so I'll place them in those contexts. Mr. Asmussen, you were before the European Parliament, I believe, about 2 or 3 weeks ago for the Monetary Committee. And I pulled a quote from your text there, and you noted, without a regime change, which I thought was a wonderful, different context here, I think, without a regime change in policy implementation and a much broader political consensus in favor of painful but necessary reforms, there is a high risk that the program derails. Now, you were speaking specifically of the Greek adjustment program. But as we've noted, we have the potential for some regime change in the next several weeks in Europe. The French elections could bring a new administration forward. The Greek elections, May 6th, we have important elections. Are you concerned the ECB is getting pulled into this political discussion, particularly Mr. Hollande and Mr. Sarkozy have been talking about the role of the ECB, how that makes your work harder? And Carl Taylor, if you could give us a sense of this important French-German European tandem that moves European policy forward. If we see a different tandem, how will that affect the larger European strategy? And then my second question, I think directly to you, Mr. Asmussen, are you concerned about the long-term health of the central bank's balance sheets? Jens Weidemann, the head of the Bundesbank, has been concerned about the Target 2 and the balance sheets. You're concerned that this crisis has moved from one of being on private sector balance sheets to public sector balance sheets. And can you give us a sense of your long-term perspective about the health of those balance sheets? Easy questions to get them started, and then we'll let you ask some questions as well. Mr. Asmussen, and you have to click on your little, you both have to click on your little.
Okay.
Okay, if they're not on. We have to have you on.
I think they are on.
You're on, great, thanks.
I mean, no, I'm not concerned. I mean, the ECB treaty has given us a clear mandate. This is to maintain price stability in the euro area as a whole. So this is not a country perspective, it's a European perspective, to contribute to financial stability. And this is the mandate we have. It's fixed in the treaty. I think it's a good mandate. And yes, of course, top politicians can discuss this. They can decide if they want to change the mandate. For us, as an ECB board member, we fulfill the mandate that is given to us. And as I said, I think it's a good mandate that serves Europe and its citizens. And for all that, what we are doing, France and Germany are at the very core of the currency area. And I'm very convinced this will stay. And what I would expect that in all countries which face now elections, and you mentioned Greece, you mentioned France, that simply the new governments stick to the promises that the previous governments have made. In Greece, which is a program country, and what you quoted referred directly to Greece, it was a European Parliament hearing on the Greek program. I would hope and expect that whatever government is elected, this is up to the Greek citizens, that the new government takes full ownership of the program, because this is a key condition that the program can be successful. And one can really see in Portugal and in Ireland that full ownership, that means even ownership that goes beyond the political parties who support the existing government. This really helps to implement and make a program successful. And I would expect that this happens in Greece as well. In France, one could focus at many points. I would, for example, expect that whoever runs the next French government, they stick to the promises they made under the Stability and Growth Pact to reach a deficit below 3% of GDP next year. So elections, no, they do not concern me. Second question about our own balance sheet at the ECB. It's a normal instrument of any central bank to expand the size of its balance sheets in a kind of crisis response. We've seen this in the past decades around the globe. In recent times, the Bank of England has done this, the Bank of Japan, the US Fed, and the ECB as well. So I think it's a normal crisis response instrument. There are clear limitations, for example, by the mandate that is given to us, and by the risk management techniques that we use to monitor our balance sheet. I think it's undisputed, and it's without saying that Jens Weidmann is right in this respect, that the risk of our balance sheet is greater than before, but we closely monitor them. and the risks are clearly well managed and under control. The question one always has to ask if one is a practical policymaker, what alternative would have been less risky? So simply doing nothing also could have harmed the quality of our balance sheet. And one has to compare these different actions. So one cannot simply stay apart and do nothing, because also doing nothing is a policy decision. So yes, the risks have increased. I think they are well managed and they are under control, and we monitor for example, the value of our collateral that we have on a daily basis. If the market value decreases, we impair higher haircuts on the collateral that we use. So I think we have risk management techniques in place to deal with the risk.
Regarding Greece, I can only hope that the future government makes the decisions and not the streets. And I have the hope, but it's hard to predict. In respect of France, I'm convinced that they will not break the tandem that has been built up now during the last couple of years and months, specifically when it comes to the crisis scenery as such. And if we should see a new government in France, I don't think that a new president will repeat the sentence that Sarkozy has made, that France has to become a little bit more German. And I wonder how helpful this was, and is that very sentence regarding the upcoming elections. But the German chancellor is certainly experienced and pragmatic enough to seek a very close relation and even friendship. And whatever is being written right now about the different party camps that may have to work together, we have seen very, very close relations between France and Germany, between Helmut Kohl and François Mitterrand years ago, and between Helmut Schmidt and Giscard d'Estaing and other when it came to the core questions. And so in this respect, I'm not concerned at all.
Great. Wonderful. Now it's your turn. We have microphones, and I think what we'll do is we'll take a couple of questions together, if that's all right. It may stretch you a little bit, and we'll just work across the room, and we'll start right here. Yes, sir. Please, your microphone is coming to you. Thank you.
Thank you very much. The Spanish regions.
I'm sorry, could you please identify yourself? Goodbye.
Clem Miller of Wilmington Trust Investment Advisors.
Thank you.
Spain's autonomous regions have very large deficits, which contribute significantly to the Spanish overall national deficit. What should Spain do about this?
Thank you. They will just work across the room. There was a question right here. Thank you.
Sure. American Development Bank. Somehow European economists have been able to convince themselves that fiscal austerity basically could lead to economic expansion. And that's a bit of a problem, because not for all countries in Europe were fiscal problems really the cause of the situation they're in. Certainly not for Spain, certainly not for Ireland, and up to a high extent not for Italy. There were other factors like banking crisis or real estate bubbles, or basically a gradual decrease in their external competitiveness. Now, we are now really facing a competitive issue in most of the European or Eurozone countries. And the problem with the fiscal pact, sympathetic as it is, it has some moral code in it that I as a Dutchman understand and you as Germans understand very well. But it's not really right now a possibility for a country like Spain, with a 50% youth unemployment and a 22% overall unemployment, to go in a very strong fiscal contraction process and expect to get out of it and stay intact politically. And if the political basis falls away under the whole thing, the whole basically Euro prospect will suffer very much. Observation.
Thank you so much. We have one back there. Yes, sir. I'll get over there.
I'm Ben Carliner from Institute. I was and about your hope for a European-wide resolution authority, specifically in the context of the Spanish financial sector. As you know, Spain's got private sector debts that I believe are approaching 300% of GDP, and there's a lot of concern that as real estate prices continue to decline, banks are going to have to write off an ever larger proportion of loans. Given that the Spanish state doesn't seem to have the fiscal space to recapitalize these banks, what do you think of proposals that have been floated to use the European Financial Stability Fund to recapitalize the Spanish banks?
Thank you. We'll take one more down here, Molly, right here. And then we'll let you respond. We're piling up here.
Alex Breter with SEGS at Johns Hopkins. My question is basically just in addition to the previous question. If the FSF and the future ESM are not allowed to recapitalize European banks, particularly in countries such as Spain in this case, would the ECB be prepared to launch a third tranche of an LTRO? Since many on this side of the Atlantic are saying that the effects of the first two tranches are already wearing off.
Thank you. I think, and I'm just going to add one. Were you surprised how quickly the LTRO effects, were you surprised at the length of their sort of wearing off effect? You can argue that they haven't worn off, but I'd like just to add one little caveat. Were you surprised how the time that has gone through and now we're seeing an uptick in the borrowing costs? That's a long list. Wonderful questions. Mr. Asmussen, fire away. he just gulped.
I thought you would start, but
take those away.
Okay.
Very happily silent.
Yeah, exactly. Me too.
I take one of those questions as well.
which one do you want?
About what measures we are talking about in Spain, maybe.
Okay, good.
Yeah.
Then I leave the Spanish
They're
regions.
waiting for your answer, actually.
First, leave the Spanish regions to you. Start with then, let's say, the Dutch question. I mean, first, yes, in some countries the fiscal aspect was not at the beginning of the crisis, but let's say in a country like Ireland, where the government had to guarantee at a certain point of time the whole banking sector with a blanket guarantee, the bank debt became public debt. And for any kind of investor, it doesn't matter what was the original reason where the debt piled up. So, but I agree that certainly in some countries there was and there is clearly a competitiveness problem according to all measures of competitiveness, like unit labor costs or whatsoever. So we have the dual task to fix these two things at the same time. To consolidate on the fiscal side, at the same time to restart growth. I think this is possible. There are examples. If you look at, for example, Latvia, this is a very positive example how a program can be executed and the government was re-elected. On the fiscal compact, you alluded to, and here I want to support what Karl Theodor to Gutenberg said, it is really a first and very important step towards a fiscal union. More steps have to follow, but we need to create a fiscal union in order that we complement the monetary area with a kind of fiscal arrangement that satisfies the stability needs a currency area has. So we really need to embark on this. I think it's no contradiction to do what you suggested, that one complements the fiscal compact by growth-enhancing measures on the member states level or on the level of the European Union, but not weakening the fiscal compact, so not reopen this. I clearly see complement by growth-enhancing measures, and you can have a whole range of measures using European Investment Bank project bonds or whatsoever. But it's clearly a complement, it's not a substitute for the fiscal compact. On the European bank resolution, this goes in the same direction. I say this in a general sense, not relating specifically to Spain. It's again a concept how you complement the monetary area to make it more stable in the future. Fiscal union is one concept, and if you look at a kind of banking union, it's a different but a separate concept, that you say we need measures, especially for the Eurozone, on the banking side to make the currency area more stable. So this is a general concept, and as I said, I'm happy if you do this at the EU level at 27, but only if we are not successful in doing this in a relatively quick time. We should resort to the Eurozone as a subgroup, as a coalition of the willing that goes ahead. On the EFSF and the ESM, it is right that both instruments do not have the ability to directly recapitalize banks, but both instruments have the ability, as a part of a program with a country, with a central government of a country, to use part of the funds directed to the central government and via the central government, then to recapitalize banks. This is part of the program for Greece, for Ireland, and for Portugal. So this has worked pretty well. So I don't see this as a major obstacle that both EFSF and ESM cannot directly interfere with individual banks. You can do this via a central government, but as part of a program where clear conditionality is attached to this program. So this is possible. Spain has not asked for this, and it's completely up to the Spanish government to decide if they want to ask for this or not. They have not done this. And about the LTROs, I repeat very carefully what I always have said regarding this in the last weeks. We never pre-commit our actions. We do what we need to do to fulfill our mandate, and by the fact that we have done 2 LTROs, no one should conclude that we automatically would do a 3rd or a 4th one. We think as ECB we have done what we needed to do. We think the LTROs have had a positive effect. They continue to have a positive effect. We have to see how this feeds through to loan provision to private household and SMEs. And now it's clearly with the governments of the Eurozone that they fulfill their part of what needs to be done.
Regarding the LTROs, these were the words of a sphinx here. That's, but I take.
You are a freer man.
And I'm skeptic regarding this. To see more of those and to see it as a self-fulfilling prophecy, I think we should be very cautious not to push it into that direction. It's very hard to me to answer to the question of the Spanish regions. I think you may draw an analogy to what has just been said to Spain as such, that we first need actually a mixture of the measures and to see complementary ways. And from that complementary ways, I think there's a greater flexibility even for Spanish government than to reach out to the distinct ways the regions look like at the very moment. In Germany, we have a tendency to, let's say, impose our experiences in discussions to other European partners, and the preconditions are dramatically different when we look at Spain or at Germany, specifically there. And of course, one can learn of certain reform steps we have made, and I gladly point, and it may sound a little bit peculiar out of the mouth of a conservative, but I gladly point at the Agenda 2010 of Gerhard Schröder, which was one of the bravest reform steps in the latest decades, and the numbers and the developments we see right now are clearly linked to those reforms as well. So, but it's nevertheless incredibly hard to compare, because that's what I've said just before in my opening statement. We have such a heterogeneous eurozone, and we should be very careful from the German side to ask again and again to take our austerity measures, our labor market measures, all of the things which were right at the time we did it, as a clear-cut example for other European member states. So I think what has just been said before, we need a combination, and we need a wise combination, which is not only austerity when it comes to Spain.
Well, ladies and gentlemen, thank you so much for being with us this evening. Mr. Asmussen has a very busy weekend ahead of him with lots of meetings, and you'll see the traffic around CSIS is a testament to that, of those very busy meetings. But thank you, Mr. Asmussen, for your insights. Karl Theodor, thank you for your comments and your reflections. And again, please join me in thanking our colleagues for their insights this evening.